So yesterday we looked at a situation where the company can issue an instrument that is going to be a debt instrument, and that will be for financial liability. Okay, so the company can issue a debt instrument or equity instrument, but sometimes the company can also issue what we call a hybrid instrument or a compound instrument. How does a compound instrument works? What is going to happen is that the entity will issue an instrument and they will be asking the holders of the instrument to convert it into equity shares. So they will issue a debt instrument and say you have the right to convert the instrument into equity shares, or a convertible instrument, that instrument that is having the characteristics of both equity and debt. So how do we account for this? How do we account for this? Okay, so I will say something here that you have to uh take care of. Okay, so for the convertible instruments, the holders can only convert into equity when the conversion value is likely to be higher than what? The redemption value. What do I mean by the conversion value? Okay, if the instrument is being issued for 5 years, if the instrument is being issued for 5 years, if the instrument is being issued for 5 years, okay, it is always likely that it will be redeemed at par, which is the nominal value. So let's say that the nominal value is going to be 100,000. Okay. At the end of that 5 years, if they want to convert into equity shares, their conversion value is going to be 120,000. So it's either you accept equity shares of 120,000 or you take your money back at 100,000. Yes, you are going to be accepting equity shares because the conversion value is higher than the redemption value. Okay, so the holders of the instruments will only convert when the conversion is going to be is going to favor them. It's going to give them higher value than the redemption value. Okay, but these people, they have the option to convert. It is not compulsory for them. They have the option to convert. They can decide whether they should receive equity shares or they should receive their money. Okay, so whatever convertible instrument that you are going to be seeing, the conversion will not be compulsory. It will be an option which they can choose to exercise it, or they can choose to uh, renounce it as well. But you can be given a question where they will say there's a mandatory conversion. Whether you like it or not, you have to convert it. How do you go about that? How do you go about that? How do you classify that particular transaction? But the question, the one that we are going to be looking at is not going to be mandatory. It's just an option. If you like, exercise it. If you don't like, you can renounce it. Okay. So what if the question is telling you that these people, they have a mandatory the instrument issued is a mandatory Okay. So the mandatory conversion, how do you account for this? Okay, accounting for this, you have to look at the characteristics of debt or equity. Okay, you have to ask yourself, does the entity have the obligation to pay the interest up to the date of the conversion? Does the entity have the right or the obligation to pay the interest up to the day of conversion? If the entity has the right to pay the interest up to the date of conversion, then this will be accounted for as debt instruments. So the interest payment, do we have to pay the interest on the on the instrument to the date of conversion? Even if we are not able to pay the interest, do we have to accumulate it up to the date of conversion? If yes, then that will be a debt instrument. We account for it as if it's a normal convertible instruments. But if the entity can decide to pay the interest at any time, the entity, there is no obligation under the what? Under the terms that the entity have to pay the interest every year up to the date of conversion, then this will be classified as a what? As equity instruments. So you just have to, for the mandatory, you just have to ask whether the entity has the right to what? To pay, or the entity has an obligation under the terms and conditions towards this particular instrument up to the date of what? Of conversion. So you just have to look at the characteristics of debt instrument or equity instrument. So if the instrument is having the characteristics of debt instrument, that the entity has the what? Has a right to pay all the interest on this particular one at the date of conversion, then you account for it as a normal convertible instrument. But if the entity can choose either to pay the interest or pay anything, then it means that this is going to be seen as what? An equity instrument, because it's only equity instrument that we can decide to declare dividend. We can decide to pay dividends at any time. We don't have any obligation to pay dividends every year. No. So you just have to subject the what? The instrument to the equity or debt classification test. That's all. So you can see a question that they will tell you the conversion is mandatory. You just have to look for. They will ask something to see whether it should be classified as equity or it should be classified as debt. They will add certain characteristics to it, to that particular instrument for you. All right. So if it is a normal convertible instrument, what do we do? What do we do? What we do is that we try to find the debt components, and we also try to find the equity components. So the instrument is going to be having debt and also equity. The equity will always represent the option to convert. So we have the option to convert. Okay. So how do we account for this? Okay. For the debt instrument, we are going to be paying interest, and we are going to be redeeming this at the end of the year. Okay. You can see that if you are giving me a certain amount of money today, if you are giving me 20,000 today, and I'm going to be paying you interest, we can say that it is the amount that you are giving to me today, that is why I'm going to be paying you interest. So because I'm not going to give you the amount today, I'm going to be paying you the interest maybe in the future or maybe in some time to come. Okay. So all these interest, all this amount that I'm going to be giving to you are always towards the what? The amount that you are giving to me today. So what do we do? If I find a present value of all the amounts that I'm going to be paying to you, will it be the same as what? The amount that you have given to me. If you have given 20,000 to me today, because of time value of money, I'm going to be paying you some interest. The interest payment is towards the amount that you have given to me. That is why shareholders will invest money into the company and they will be receiving dividends. They can receive the dividend up to a certain point and say, even if this business closes down, we are okay. We are not going to do anything. It means that they have received the dividend up to the what? The amount that they have invested. So the debt component, how do we separate this? We have to separate the debt component from, so we have to do the separation. We have to do the separation. Whenever you have a question, you have to do the separation. How do we do the separation? The separation, we separate the debt component, and the debt component is always the what? The present value. We just find the market value of the debt instruments, like the way we do it under business valuation. So that how do we find the market value of the debt component? It is the present value of all the cash flows, present value of all the cash flows, discounted using the market value, the market interest rates, market interest rates of similar instruments without conversion or discounted using what we call internal rate of return of the company. Okay, we are just using cost of debt. Okay, so it's the present value of all the cash flows discounted using the market interest rate of a uh, instrument, similar instrument without conversion or the internal rate of return of the company. How do we find the equity component? The equity component is just a difference between the equity component is a difference between the amount that we are receiving and the debt what value. That's how we do. How do we? They will give you everything. They will give you the nominal rate. The nominal rate. They will give you the market rate of a similar debt without conversion, and they will also give you the equity what the equity. For the equity, you have to calculate the equity yourself. Okay, so they will give you everything. What are the cash flows? You'll be paying interest on the debt. Those are the cash flows, and you'll be redeeming this particular debt component at the end of the year. All those things you discount them, and you have what we call the present value of all the cash flows. Okay, it can also happen that the instrument can be issued at a discount. Okay, how do we account for the discount? If the instrument is issued at a discount, what we do is that the discount is immediately reaching off against the the amount. So if you are issuing at 20,000 and there was a discount of 1,000, the amount that we'll be using is 19,000. Okay, it is 19,000 that you'll be putting there as what? As a redemption value. Okay, it is 19,000 you'll be putting there as redemption value. Okay, so the discount will be written off against the amount immediately, but the interest will be paid on this amount, which is at the 20,000. Okay, because we are giving the people a discount of 1,000. It means that to them the bonds will be carried at what? 20,000. But because we are using a standard to account for this, that is what we are doing. Okay, but if there's an issue cost, if there's an issue cost for the transaction cost or the issue cost, what we do is that the issue cost will now be, you first of all, if there's an issue cost, you first of all have to find your debt component. You don't write the issue cost against the amount that you have received, because the issue cost is relating to equity, is relating to what? The debt also. So you find your equity components and the debt components. So let's say the equity component is 19,000, the debt component is 1,000, and the issue cost is 500. Okay. So what you do is that you first of all do your separation. So after doing the separation, then you come and share the issue cost to them based on this figure. So that would be 19,000 divided by 20,000 multiplied by 500. That would be for debt. Equity will be 1,000 divided by 20,000 multiplied by 500. So if you have issue cost, first, don't write the issue cost. The issue cost, we are writing it, you are not being fair, because the issue cost is relating to two instruments, equity and debt. So we have to find what portion of the issuing cost is for equity, what portion of the issue cost is for debt. All right. So basically, this is what you are going to be doing. Let's pick at least two questions. We finish it, then we all go back to our sleep again. All right. So let me see. All right, let's pick question 2 and 3. Question number 2 and 3. Yeah. Roxanne, can you take the question number 2 first?
Okay, question 2. Tom T issued 1 million convertible bond on 1st June 20x6. The bond had a term of 3 years and were issued for their fair value of 100 million, which is also the par value. Interest is paid annually in arrears at a rate of 6% per annum. Bond without the conversion option attracted an interest rate of 9% per annum on 1st June 20x6. The company incurred issue cost of 1 million. The impact of the issue cost is to increase the effective interest rate to 9.38%. At 31st May 20x9, the bondholders can opt to be repaid the par value in cash, or they can opt to receive a fixed number of ordinary shares in Mampon. Required. Discuss the accounting treatment of the convertible bond in the financial statement for the year ended 31st May 20x7.
Okay, thank you. So please, as soon as you see something like the instrument can be converted or the people can opt to receive a fixed number of shares and all those things in equity shares, we have to know that that is a convertible instrument. Sometimes they will not give you to you like that. They can give you, the company has a redeemable preference shares of this, but the latter part of it, they'll be saying that the holders have the right to opt for ordinary shares, or they can choose to redeem at par. Okay, please, you always have to pay attention to the redemption value. It can be done at a premium. The redemption can be done at a premium. So you just have to know how are they going to be paying the instrument back, the amount back. It can be paid at a premium. It can be paid at a discount. It can be paid at par. The par means that the nominal value. Okay. So what we have to do is that we are receiving 100 million. This is going to be for 3 years, and this is a convertible instrument. So what we have to do is that we have to now go and do the separation. So we have to go and do the separation. So that will be question number 2, the term T. Okay. So we have to do the separation. The separation will always be, you do the debt component first. So the debt component will always be the present value of all the cash flows. How do we go about that? We have the years, we have the cash flow, we have the discount factor, then we have the present value. The discount factor will always be the market interest of a similar bond without the conversion rate, which is what is the rate there?
9%.
9%.
Okay. So the debt will be 9%. The interest rate will be 9%. Okay, please. How many years are we going to pay the interest on this particular instrument?
Four years.
Is it 4 years?
It's one, but then
What is the useful life of the instruments? The bond had a term of 3 years. Okay, the bond had a term of 3 years, so we are going to be paying the interest for 3 good years. Yeah, Rox, your hand is up.
And please, so I'm also seeing some 9.38 somewhere.
9.3 is as a result of the issuing cost. So the issuing, after we have apportioned the issuing cost, that is what you'll be using to find your interest on the debt component. Okay. So that effective interest rate over there is because of the issuing cost. So that will be after. after the separation issue. Okay. Okay. So you can see that the impact of the issue cost is to increase the effective interest rate to 9.38. That is after we have apportioned the issuing cost. After we have apportioned the issuing cost to the debt instrument, the issuing cost has to now increase the what? The effective interest rate. That is after. Please always the debt component will be separated using the what? The market rate of a similar instrument without conversion. The market rate of a similar instrument without conversion. That is the rate that you'll be using. All right. So we are going to be paying interest, or these people are going to be receiving interest for 3 good years. They are going to be receiving interest for 3 good years. So they are going to be receiving interest for 3 good years. How much will be the interest every year? How much will be the interest every year?
6%.
6% on which amount?
On the 100 million.
Okay, 6% on the 100 million. So the interest that they are going to be receiving is just the coupon. Okay, what you people have been calling coupon. So this is going to be for 3 years. So that is an annuity. So you can put annuity there to be 6 million. Okay, at the end of the 3 years, what is going to happen? This will be redeemed at what? At the end of the 3 years, we are going to redeem the what? The amount at par. Okay.
106.
No, at the end of the 3 year will be 100. Okay. Because the 6 is already captured in the 1 to 3. Unless you are doing it one by one. Okay. So we are going to be paying the amount back at 100 Ghana cedis. So let's look at annuity 9%. 1 minus into bracket 1.09 expo negative 3 divided by 0.09. And also the discount factor 1 divided by 1.09 exponent 3. What are we having for the 2?
2.53.
So 2.53 for this one. The last one is what?
0.77.
0. 0. 0. What?
0.77.
Okay. All right. So what will be the present value for them?
15.18 for the first one.
15.18, and this will be 77.
77.
Okay. If you add it to, what are we getting?
92.18.
92.18. So this is a debt component. Okay. This is a present value of the debt component. Okay. This is a market value of the debt component. But how much are we receiving? What is the total amount that we receive? What?
100 million.
We receive 100.
Okay. So what is the difference?
7.82.
So 100 minus 92.18. That will give you the 82. That will give you 7.82, isn't it? Okay. That is the equity component. So the second thing that you have to do is that this is the initial recognition. You separate it, the equity component, and also the equity over here, you add it to other component of equity. Okay, because it has not been what? It has not been, the option has not been exercised yet. So this is the option to convert. So after this one, equity, as soon as equity is being measured, we don't remeasure equity. So it will be at the 7.822, or if there is any issuing cost, we write it off and go and put that value there. But for the debt, what will happen is that at the end of every year, we have to find our finance cost on it and take the coupon out of it. So the debt will be carried at amortized cost. That is the subsequent measurement. So it will be accounted for like the normal financial liability that we looked at yesterday. But let's come to, there is an issue of what? Issuing cost over there. So let's come to apportionment. Let's come to apportionment of issuing cost. All right, so let's come to the debts. The debt components. The debt component will be, this will be shared based on their what? Their carrying values. So we have 92.18 divided by 100 multiplied by 1 million. Okay, that is for the debt. Let's come to equity components. So equity components, or equity, will now be having the 7.82 divided by 100 multiplied by 1 million, which is the issuing cost. What are we getting?
921,800. The debt.
Let's do it in the million form.
Okay. So 0.92 million.
0.92 million. Okay. Then
0.08 million.
so 0.08 million. Okay. So let's come to their fair value now. So the fair value of debt will now be, or let me just look at the subsequent measurement of debt. Okay. Subsequent measurement of debt will be, we have the amount at start. The amount at start will be, you can bring the full amount over the 92.18. 92.18. What will happen? We have the issuing cost. Issuing cost of how much? 0.92. So you take the 0.92 from it. How much are we going to be getting?
91.26.
Okay, 91.26. Then you now have your finance cost. So it is in the calculation of the finance cost that you'll be using the 0.93. Because if the 0.9, if the issuing cost is not given to you, you use the rate that you have used to what? To discount the cash flows. You use 9%. So 9% will be the effective interest rate, and the 6% will be the what? Will be the coupon rate. But since you are giving issuing cost now, it means that we have now revised our effective interest rate to reflect what? The effect of the issuing cost. So you'll be using the 9.3% for the finance cost. Yeah, Roxanne, your hand is up.
So please, what if they give you the finance cost but they don't change the rate?
If there's an issuing cost and you don't change the rate, you account for it the way or what I said yesterday. You have to show the the issuing cost as a separate item because it has not been factored into the effective interest rate. So you don't have to subtract it from that. All right. What is the finance cost?
Sir, please, can you take the statement again?
Okay. I'm saying that the if they have given you an issuing cost, but the effective interest rate, which is a 9%, have not been revised, it means that the issuing cost, the effect of the issuing cost, when you subtract it from the debt, have not been factored into the effective interest rate. So don't go and subtract. Go and treat the issuing cost as a separate item. Capitalize it and amortize it over the 3 years or over the life of the instrument. All right. What are you getting as a finance cost?
$8.49.
Okay, 8.49. So what will happen? We will pay what? We will pay the interest to them at the end of this year. That will be 0.06 multiplied by the 100. So we have coupon of 6. What are you having? I'm having 93.75. Okay. For equity components, what will happen is that equity components, the amount that we are going to be showing will be the fair value of the equity. That was 7.82 million. Then what will happen? What is the issuing cost portion on the equity? 0.08. Would this be a reduction or increase? Are we adding the issuing cost or we are subtracting?
Please, I think you have to add because it's
Yeah,
3 years off.
Who said that? They say equity. Equity is it an asset?
yeah, it's an asset.
Hi. If you are showing equity, is equity an asset? Roxanne, equity is what? If you are using a business entity concept, equity is classified as what?
Is added to the liability and compared to the asset.
Okay. So if you're using a business entity, we don't have anything like capital. Everything over there is liabilities compared with the assets. Equity is having a credit balance. So issuing cost is not an expense. So if you are capitalizing it, you are subtracting. Don't go and add the issuing cost to the equity. You subtract because the equity is having a credit balance. It's also seen as a liability under the business entity concept. Okay. The shareholders are the owners, but the company is going to be paying them that amount. So it's an obligation. It's a form of obligation to the entity. Okay, but just that we are not going to pay the money back, but it is not asset. Equity has what? A credit balance. So issuing cost is a debit. And if you are going to capitalize, it means that you are going to be what? Crediting, you are going to be debiting the equity account. And by so doing, you are subtracting. Please, we only add the issuing cost to what? To assets, because the asset itself is having a debit balance. So if you are capitalizing that, it means that you are adding. Okay, so don't go and do that. All right, what are you going to be getting for the equity?
Is it 0.08 or
7.74.
0.92?
It's 0.08. The issuing cost that we
Yeah,
show.
7.74.
The debt is 0.92. We have done that for the debt. 7 points.
74.
Okay, 7.74. So if you like, you can show your statement of you can show your statement of profit or loss, or you can show your statement of financial position. But the question was discuss. So mostly if they are saying discuss, I can just mention the figures that will go to statement of profit or loss. and statement of financial position. So what we are going to be saying is that you can't discuss this without doing the calculation, because they have given you figures and they want to know how they are going to be accounting for this. It's not the English that they want, that, oh, this should be accounted under the financial instrument, convertible, separate the equity and separate the debt. If you are directing the person like that, separate equity and separate debt, what is the person going to be taking? Or what are the figures that the person will be getting? So you have to separate the equity or the option to convert from the what? The option to convert from the debt component. How do you do this? You find the market value of the debt by discounting all the what? All the cash flows relating to the instruments using the market rate of a similar bond without what? Conversion. After that, you subtract the market value from the nominal value, and that will give you equity component. Then you also talk about how they can apportion the issuing cost, and you can do all these things and use your English to back it. So at the end of the day, you tell them that finance cost of 9, finance cost of 8.49 should be charged to profit or loss, and the debt component should be shown as a non-current liability at 93.75, and the equity component, which is the option to convert, should be added or should be shown as other component of equity at 7.74. That is what you are going to be telling them. Okay, sometimes the question at the end of the year, if the people are converting now, so maybe I don't have a question on that, but mostly they will not be asking you those ones. But what if you come across a question like that? If the people have now decided, or the holders have now decided that they want to what? They want to convert now. If they have decided that they want to convert now, we have the option to convert. Okay, this is not part of the question. We are done with this question. The option to convert is 7.74. Okay, let's assume that at the end of the 3 years, the value of the debt, okay, the value of the debt is, let's say the value of the debt is, let's see, okay, let's say it's 100. The conversion will be done at the end of the year. So the value of the debt is now 100. Okay, what is going to happen is that we will be having 100 or 107.74. Okay, that is the total amount that we'll be having for them. The option to convert will always be there, and the debt value at the end of the 3rd year, this is also this one. Let's assume that we are now giving them equity shares. Okay, let's assume that we are now giving them equity shares of what? Of 110. Okay, we are giving them equity shares 110. The option will always be transferred to equity shares. If the option is what? Is exercised, then we always transfer to equity shares. So you see that the total amount that will be transferred to equity shares will be the option, and also this. We are converting this to equity shares, and this is also the option to convert. That is also part, and that will also be reclassified to equity shares now. So the total amount that we're supposed to transfer to equity shares is 107.74. But how much are we giving to them? What is the value of the equity shares are we giving to them?
110.
Okay. Whenever you are issuing shares and you are receiving lower than what you are giving out, the shares has been issued at what? When you issue shares,
Discount.
the share has been issued at a discount, isn't it? Okay. So what you do is that you are going to be transferring this value from the debt or from the liability to equity. You are also going to be transferring the option to equity. But the next one will be, okay, let me just use the entry here. Let me use the double entry to see. You debit the option to convert because it's going to be having a credit balance, 7.74. So you debit the liability also. It's also having a credit balance. So debiting means that you are removing. Then you now debit discount, which will be profit or loss. But if you like, you can capitalize the discount as a fictitious asset. Okay, but that will not be, so you just write it to profit or loss there. So what are we having? The difference is what?
3.74 off.
It will be the 110 and this one, it will be
2.26.
okay, 2.26. Then you now credit your equity shares. Okay, you now credit your equity shares of 110. That is the shares that you are giving to them. Okay, the same way you can be having this. The same way you can be giving them equity shares of 105.74. Okay, so you can see the amount that we are what? The amount that we are giving to them is lower than what we are receiving. So in actual sense, the equity shares that we should issue to them should be the same as this. That is why there is not going to be any discount or any premium. Okay, but we are now giving them 105.74 for 107. Whenever you are issuing shares and the shares that you are issuing, the value is lower than the amount that you are receiving, the shares is being issued at what?
At premium.
At premium. So what you do is that this is the value that will go to equity shares, but the difference over there, which is 2, will be credited to what? The share premium accounts. Okay, so but this one you will not be, maybe I don't think you can see a question in the exam where they will ask you to do it up to the last year. This is done at the end of the last year. It's the end of the last year that we normally convert. So they will decide whether to convert or not. So, but if you should go and see something like that, you remove it. Either the shares will be issued at a discount or the shares will be issued at a premium. Okay. The question 3, and we move on.
On question 3.
Yes, please.
On 1st January 2021, WL issued 12.5 million bonds of 100 Ghana cedis each for 1,250 million. The related transaction costs on issuance amounted to 50 million. Each bond is convertible on 31st December 2024 into 2 ordinary shares at the option of bondholders. Any unconverted bond will be redeemed on that date at par value. Under the terms of the bond, there is no interest on bond for 2021 and 2022. However, interest is payable at 16% per annum on 31st December 2023 and 2024. On the date of issue, market interest rate for similar debt without conversion option was 12% per annum, payable each year. However, on account of transaction cost incurred on issuance of bond, the effective interest rate would increase to 13.2 per annum. In the financial statement, the proceeds have been recorded as a convertible bond classified under equity, and the transaction cost has been expensed out required. Please, can you? In line with IAS 32, financial instrument presentation and IFRS 9 financial instrument set out and discuss the accounting treatment of the above issued bond within WL's financial statement for the year ended 31st December 2021.
Okay. So there is a convertible instrument in the. So first of all, you have to always determine the par value. Okay. So this one, they are so generous and they have given you the par value. For me, I would have asked you to find it yourself. But how do you go about it? You look at the number of bonds, that you are issuing multiplied by what? The value that it has been issued out. So it has been issued at. Okay, that would be the 12.5 multiplied by 100, and that is what that's where they have gotten the 1,250 million. The related transaction cost on issuance amounted to 50 million. Each bond is convertible on 31 December into 2 ordinary shares at the option of what? Of the bondholder. At the option of the bondholder. So they are saying that at the option of the what? Of the bondholder. So it means that they can decide to convert, or they can decide not to convert. Okay. So if it is at the option of the entity, it means that the entity can call for what? The conversion. The entity can call for the conversion. So at the option of the bondholder, any unconverted bonds will be redeemed on that date at par value. Any unconverted bonds will be redeemed on that date at par value. Okay. Any unconverted bonds will be redeemed at that date at par value. Okay. So since the conversion is at the option of the bondholder, they have the right to decide whether to convert or not to convert. Okay. Under the terms of the bond, there is no interest on bond for 2020, for 2021 and 2022. However, interest is payable at 16% interest per annum on 31 December 2023 and 2024. On the date of issue, market interest rate for similar debt without conversion option was 12% per annum, payable each year. However, on account of transaction costs incurred on issuance of bonds, the effective interest rate will increase to 13.2% per annum. So this one, they have revised your your effective interest rate for you now from 12 to 13.2. It means that you have to subtract your issuing cost from the debt component. In the financial statement, the proceeds have been recorded as convertible bond classified under equity, and the transaction cost has been expensed out. So you should set out how this should be accounted for. All right. How do we go about this? Question number 3. How do we go about this? Yes. It's an interruption. How do you go about this? Convertible instrument. What is the first thing that you have to do?
Okay, so I think we have to find our cash flows. That's the interest that we'll be paying. Then we'll present value them to, in addition with the final amount we'll be paying. That's the nominal value. Then after present valuing them, we'll take it out from the total amount so that we get our equity.
Okay.
Then afterwards, we share the transaction cost, proportionate for them.
Okay. So the first thing that you have to do is to separate. Since it's a convertible instrument, you always have to separate. That is initial recognition. You always have to separate. So you find the debt component is the one that you can find, because for the equity, you are not giving any information on the equity. So the debt component, we just ask ourselves, all the cash flow that we are receiving, what will be the market value? So we have the years there. You have the cash flow. You have the discount factor. Then you have the present value. The discount factor is 12%. That is the market interest rate of a similar bond without conversion. That is a rate that you always have to be using. All right. Let's come here. The redemption period is 4 years, isn't it? From January 2021 to 31 December 2024. That will be what? 4 years. January 2021 is another year. 2022, 2023, and 2024. Okay. They are saying that under the terms of what? Other the terms of the bond, there's no interest on the bond for 2021 and 2022. So it means that we are going to be receiving interest payment for only two times, isn't it? Okay, and that would be for year 3 and year 4. So year 1 and 2, there will not be any interest. So this one, don't use annuity, because if you want to use annuity, you have to find the 4 years and subtract the first 2 years discount factor from it. So you just have your 3 years over here, and the interest will be how much? What will be the interest that we are going to be paying?
So are you going to use the 16%?
However, interest is payable at 16% per annum on 31 December 2023 and 2024. Assuming I wasn't there with you, which rate are you going to be using? You have 3 rates over here. You have the choice to choose any of them. Which one are we choosing?
And me, I'll still use the 12%.
Then your everything, you are going to be wasting time on that question. So leave that question and move on to another question. Okay.
Hello, 16%.
Yeah. Yes, please.
Interest is payable at 16% per annum on 2023, 2024, which means that 2 years has a separate rate. And when you
the 2 years is having the same rate.
Yes, having the same rate.
Yeah.
And on the date of issue, market interest rate for similar debt without conversion option was 12%, which means that the Fed 2001 should be 12%.
No, please.
No, please. Okay. Then explain.
The interest, you see the market, the market rate of a similar bond, that is the cost of the instrument itself. Okay, we are calculating it based on market value. That is the cost of the instrument. But if you are going to be paying interest, you will pay the interest at the nominal rate. Okay, if you are doing cost of capital, you are issuing debentures at what? At 10%. But you want to find the current market cost of what? Of the debenture. What you are going to be doing is that you are going to be finding the cost on what? On the market value. So the cost of capital can be different from the nominal rate. But if you are going to be paying interest, the interest will be paid at the interest rate attached to what? Attached to the instrument, and that is the 16%. The interest is payable. However, interest is payable at 16% per annum on this. This is the interest that you are going to be paying. That is the amount that you are going to be paying. You are going to be paying interest to them at 16%. That is the amount that they are going to be receiving. That is the cash flow for them. But for the 12%, it's just the cost of the debt, which we are calculating our own ways. But at the end of the day, we pay the interest to them at the nominal value, which is the 16%. A bank is giving you a loan at 10%, but you are saying that, okay, if I should go to the bank today, the interest rate that I should give to me should be 12%. It doesn't mean that you'll be paying the interest to the bank on the new interest rate. No, it will be paid on the agreed one, which is the 10%. So that will be the 16%. Why is it 16%? It's because we are not paying any interest. It is 16% because we are not paying any interest for the first 2 years. So those interests have been captured. Into the year 3 and year 4. It doesn't mean that you're not going to be paying interest in year 1 and year 2. No. They are going to pay interest, but just that maybe the company is having some liquidity problems there. So those interests that will be paid in year 1 and 2 have been captured. It has been captured into the year 3 and year 4. Okay, so the interest will be at the 16%, not the 12, and not the 13.2. All right. So how much are we getting for the first year? The interest will be paid on the nominal value, 16% on 1,250. What are you getting?
200.
Okay. So we have the first year to be 200. I said first year, the first one to be 200. Let's come to year 4. Year 4, we'll be paying the interest together with what? With the redemption value. Okay, so that will be 200 plus 1,250. What are we having as a total?
1,450.
Okay, so what you do now is that you have to find your listing, your discount factor. The first one will be 1 over 1.12 exponent what?
Exponent 3.
Exponent 3. That is nice. Then the second one will be 1 over 1.12 exponent 4. What are we getting for each of them?
0.71. First one.
First one is 0.
First one is 0.712.
712. Okay. Please, your approximation
0.64.
your approximation should always be to 3 decimal places. 0.6.
0.636.
Okay, 636. So let's now multiply. What are we having as the cash flow for them? 142.4 and 1450 multiplied by 0.636. I'm having 922.2. Okay, plus 142.2. Okay, I'm having 1064.6. Is that correct?
Yes, that's right.
Okay, so the equity component will be how much? 1,250 minus 1064.6.
$185.4.
Okay, 185.4, 121 dash 1. So what do? We share the issuing cost, isn't it? Okay, so what you do is that you now allocate or allocation of the issuing cost or the transaction cost. Okay, so we have the debts will be 1064.6 divided by 1250 multiplied by what? What is the amount of the issuing cost?
50 million.
50 million. Okay, so this will be 185.4 divided by 1250 multiplied by 50 million. What will be the debt component?
$42.584.
Okay, 42.6. Okay, so having 42.6, and this will give us what?
7.416.
Okay, 7.4. Okay, so what you are going to do, you can subtract before you move on, or you can just go to the debt, which will be the debt will now be what subsequently measured at amortized cost. Okay, so you can come to subsequent measurement for the debt. Subsequent measurement for the debt. Okay, so we have the fair value of the debt. Okay, and that is going to be 1064.6. Then we have the transaction cost for them. Okay, so let me just look at initial recognition here. So not subsequent. Okay, initial recognition. So let me just subtract this one. So the initial recognition, let me put debts here. So debts will be will be the fair value of 1064.6. Then we have the transaction cost. Transaction cost of what? 42.6. What will be the amount that we're having?
$1022.
Okay.
1022.
Okay, 1022. Let's come to our equity. The initial recognition of equity. We have the fair value of what? 185.4. Then we now have the transaction cost. The transaction cost of 7.4. What are we having?
$178.
Okay, 178. Okay, so let's now go to the subsequent recognition or measurements. So we come to the debt. It's only the debt that will be what? Subsequently what? So we can come to the net amount or the balance at start, anyhow you call it. So the balance at start will be the 1022. Then we have the finance cost now. Finance cost of what? 0.132 multiplied by 1022. You will now use the effective interest rate taking into consideration the issuing cost, which is a 13.2% there. So what are you getting? What are we having?
134.904.
So 134.90. Okay, then we come to coupon. The coupon will be our 0. Okay, there is no coupon payment in the first year, isn't it?
Yes.
Okay, so
Yes, in second year.
okay, so there is no coupon payment in the first year and the second year. So you just add this one. Sorry, there's no coupon payment. So let's just add it and have our value. 10,022.
1156.9.
So I'm having 1156.9. Okay, that will be the closing balance. There is no coupon payment. Okay, that will be the closing balance. Okay, let's count to equity. Equity will still be shown at 178. Okay, let's look at what the question is saying there. If you go to, let me show you the extra statement of profit or loss. Okay, statement of profit or loss. They are saying that something has been done. The issuing cost has been what? The issuing cost has been what? In the financial statement, the proceeds have been recorded as convertible bonds classified under equity. The transaction cost has been expensed what? Out. Has been expensed out. So it means that the transaction cost should not be expensed. So what we do is that you have to reverse that particular one. Transaction cost of 50 million should be what? Reversed. Then you now bring the finance cost of 134.9, or you can subtract the transaction cost from the finance cost because that has already been charged to profit or loss. So you can subtract it. 50 has already been charged. So what will be the remaining amount that will be charged? So you can net it and bring the net amount over here. You can net it and bring the net amount over here. let's look at the statement of financial position. Let's also correct what they have done there. Okay. So statement of financial position, what is going to be happening? We are going to be having non-current liability, which is going to be 16% convertible bond. Okay, how much should be is supposed to bring this balance there? 1156.9. Okay, let's come to equity. The option to convert. We still have the 16% convertible bond there. How much was shown there? It was 1250, isn't it? If you read that very well, in the financial statement, the proceeds have been recorded as what? As convertible bond, classified under equity, and the transaction cost has been expensed out. So it means that they are showing the total amount as 1250 under equity, but the figure that should be shown under equity is what amount? The figure that should be shown under equity supposed to be what? What's supposed to be the value under equity?
178.
Okay, so we go now and put the 178 here by reducing this figure by a certain amount. Okay, so reduce this by 10, 7.
Debt amount.
Okay. Reduce that by 10, 7, 2. So 10, 7, 2 will be taken away from that, and the 1156.9 will give you the difference. Okay. So we have the 178 over here. Okay. So that is a correction that you'll be doing in the statement of financial position. Okay. All right. So that is all for this one too. That is all for this one too. Please, any question?
Hello, sir.
Yes, please.
Please, how did you say you would account for the
Please, can you put your mic on and talk?
I'm asking how do you treat the issue cost if it wasn't included in the effective rate of interest?
The issue cost will be shown as a separate item and amortized over the period of the instrument.
Okay, thank you.
All right.
Please,
Yes, please.
initially you were saying the interest rate should have been 16%. When our sister said she would have used 12% and said she was going to waste her time. But when we were calculating the present value, I realized we didn't use the 16%. How come?
When we are calculating the what?
When we were looking for the debt component, that's the present value. When we're calculating the present value of the debt.
Okay. We use the 16%. How did we get a 200? It is the 16% on the 1,250. But if you are finding the cash flow is always calculated using the present cost of what? The debt, which is always the what? The interest rate of a similar bond without conversion, which will always be there. That is what you are going to be using as a discount factor. But the interest will be paid on a nominal value. So the interest rate over there will not be the what you are going to be using to present value or cash flows. No, the present value will always be calculated using the current cost of what? The debt, which will always be the market interest rate of a similar bond without conversion, which is at 12%.
You said you didn't use it.
We
You
use-
used it when getting the 200. Doesn't mean the 200 was not given in the question.
200, they would no question is going to give you the interest rate. You have to, no question is going to give you interest. You have to calculate the interest yourself.
Okay, I don't have the question here. I'll get back and see.
Okay.
If anything, I'll get back to you.
Thank you, sir.
Yes, sir.
All right. All right. So if you don't have any question, anything,
Sir,
yes, please.
so please, if I get you right, then what you're saying is that when anytime the issue cost is being given, you have to treat it separately without lessening it from the fair value figure
Fair
you calculate.
value.
Yeah.
Okay. So I think my sister BC want to answer you. So BC, we are
No,
young.
no, I was telling him he wanted to say fair value, and I just wanted to say it.
Okay. Okay. That is cool. Yes, because the issuing cost is relating to two items. So if you are lessening it from it, the actual portion of the issuing cost might not be reflected in the value that you are going to be sharing. So it will be better for you to find their value first, then you issue or you share the issuing cost to them. Maybe if you less it from that, the debt might be taking more than they should. So do your own thing. It's only the discount that will be lessened from it.
Oh no, sir, I'm not referring to that one. I'm referring to the effective interest rate issue, where the
You have to ignore the 12% and use, if issuing cost is not given to you, then you use the 12%. You use the rate that you have used to discount the cash flows, which is the 12%. Okay. You use the rate that you have used to discount the cash flow, which is 12%. But if you are giving issuing cost, then it means that the 12% is only for the nominal value. So now issuing cost is coming in. So they have to revise the interest rate for you, and you have to now use the new effective interest rate.
okay, so if they don't revise it for you, that's why you are going to amortize it separately because it has not been factored into the first rate that was given. Right?
Yes, the 12% was used to just to present value or the interest and then the redemption value without taking into consideration the issuing cost. Okay, so since the issuing cost is not part, what you are going to be doing is that you have to do everything so that at the end of the day, you get the redemption value of 1,250. But if you are now including the issuing cost to the value and you are doing this, at the end of the day, you will not get the same thing. So all the things that form part of the cash flow are the things that should be considered when you are now amortizing. So you have to use the issuing cost as a separate item.
All right, sir.
All right. But those of
Sir, please, so for this question like this, it was 3 years, so that means you have to amortize the issuing cost for 3 years, right?
Exactly. No, this is 4 years.
Okay. Hey, 4 years, sorry.
All right.
Thank you.
Okay. You see, those of us that had done financial management, you see how to find value of a debt is the same thing that we are using for the financial instrument here. We are just looking at the market value of the debt. How do we do that? We present value all the cash flows associated with the debt using the cost of the debt, which is the 12%, which will always be the market rate of a similar bond without the conversion. It's the same thing that we are doing. Okay, how to find a market value of a debt, the same thing. All right. So if there are no further questions, please, we are continuing with financial assets next week. I'll see you guys on Tuesday.
Senior.
Yeah.
Hello. Sorry to drag you back. Actually,